In business, we often hear broad terms like profitability, efficiency, leverage, and growth when discussing financial performance, but it can be challenging to understand why these factors change over time. That's where DuPont analysis comes in. Created by the DuPont Corporation in the early 1900s, this method breaks down a company's return on equity, or ROE, into key components that show how well a company turns sales into profits, manages its assets, and uses debt. This approach gives us a clearer picture of what really affects shareholder returns. DuPont analysis helps us identify the true drivers behind performance, support better decision-making by showing whether to focus on improving margins, asset use, or capital structure, benchmark competitors to see their strengths, uncover hidden risks like rising debt behind increasing ROE, and guide managers toward specific improvements in areas like cost control, pricing, or asset management. Essentially, it's a practical tool that goes beyond just numbers to help businesses improve and compete more effectively. DuPont analysis breaks down return on equity into three parts to give a clear picture of where a company's strengths lie. First, the net profit margin shows how well the company turns sales into actual profit, highlighting cost control and pricing. Then, asset turnover measures how well the company uses its assets to generate sales, so higher turnover means better asset efficiency. Lastly, the equity multiplier shows how much the company relies on debt compared to its own equity, which indicates financial leverage. By combining these, we see not just the overall return to shareholders, but exactly how it's achieved, whether through profitability, efficiency, leveraging debt, or a mix of those factors. First, you need to gather the financial statements, specifically the income statement and balance sheet from the same reporting period. Then, calculate the net profit margin by dividing net income by total sales. For example, with a net income of £120,000 and sales of £1,200,000, the net profit margin is 10%, meaning the company earns 10 pence for every £1 of sales. Next, calculate asset turnover by dividing total sales by total assets. Using sales of £1,200,000 and total assets of £800,000, the asset turnover ratio is 1.5, indicating the company generates £1.50 in revenue for every £1 invested in assets. After that, you calculate the equity multiplier by dividing total assets by shareholder equity. Finally, multiply these three components, net profit margin, asset turnover, and equity multiplier, to get the company's return on equity or ROE. The last step is to interpret these components to identify which ones are strong or weak, helping to inform strategic decisions. The equity multiplier is calculated by dividing total assets by shareholder equity, which in this case is 800,000 divided by 400,000, giving us 2.0. This means the company uses £2 of assets for every £1 of equity, indicating that half of its assets are financed through debt. When we calculate the return on equity, or ROE, using the DuPont formula, we multiply the net profit margin by the asset turnover and the equity multiplier. Here, that's 10% times 1.5 times 2.0, which equals 30%. A 30% ROE is quite strong, but this breakdown shows us why. The profitability at 10% is decent but not outstanding, asset efficiency at 1.5 means the company is using its assets effectively, and the leverage of 2.0 shows moderate use of debt, contributing to ROE without being excessive. This analysis helps leaders understand that the company's strong ROE comes mainly from efficient asset use and moderate leverage, rather than unusually high profit margins. This is why the DuPont method is so useful. It reveals the story behind the numbers. For example, consider two retailers both with a 15% ROE. Retailer A has a high profit margin due to premium pricing, moderate asset turnover, and low leverage, illustrating how different factors can combine to produce similar overall returns. Retailer B operates with a low profit margin due to discount pricing but compensates with very high asset turnover and moderate leverage. Even though Retailer A and Retailer B have the same ROE, their business models differ fundamentally. Retailer A depends on strong margins, while Retailer B focuses on volume and efficiency, which the DuPont analysis clearly reveals. Looking at the manufacturing firm, its ROE rose from 10% to 14%, which initially seems positive. However, DuPont analysis shows the profit margin and asset turnover stayed the same, while the equity multiplier increased significantly. This means the rise in ROE is driven entirely by higher leverage, signaling greater financial risk rather than operational improvements, a key insight for both executives and investors. In contrast, a tech company improved its ROE from 12% to 18% through genuine operational gains. They increased their profit margin thanks to subscription revenues, improved asset turnover as they scaled without heavy asset investments, and kept their equity multiplier stable. This indicates scalable growth rooted in operational efficiency, not financial engineering. Overall, DuPont analysis offers a deeper understanding of ROE by breaking performance into actionable parts and helps leaders identify strengths and weaknesses so they know exactly where to focus their improvement efforts. DuPont analysis is especially useful when comparing competitors, as it helps highlight the strategic differences that may not be obvious from headline numbers alone. It's a valuable tool for assessing risk, because it can differentiate between a strong return on equity that comes from true profitability and one that is simply boosted by heavy borrowing. Another strength is its versatility. It can be applied across various industries, making it a flexible framework. However, it does have some limitations. Its accuracy depends heavily on the quality and consistency of accounting data, so manipulated or inconsistent statements can lead to misleading conclusions. It's not effective for companies with negative equity, since the equity multiplier loses meaning in those cases. The analysis can also be too simplistic for complex businesses that require deeper, more detailed evaluation beyond just profitability, efficiency, and leverage. Plus, it doesn't factor in cash flow, so a company might appear strong in terms of ROE even if its cash flow is weak. High leverage can also distort results, masking underlying financial problems. Despite these drawbacks, DuPont analysis remains a powerful method to break down ROE into its essential components, giving clear insights into what drives value for shareholders. Businesses use it to spot performance gaps, benchmark against competitors, and set strategic priorities, while investors rely on it to better understand returns and where potential risks may lie. Though it should be combined with other financial tools for a full picture, the DuPont framework simplifies complex financial performance into more transparent and actionable insights.